valuation, mergers and acquisitions, IPO, and private placements, debt advisory valuations. He has served clients in Bahrain, Qatar, Saudi Arabia, Jordan, Kuwait, Oman, and UAE. Ram has served as committee member of KPMG Global Valuations and M&A committees and was head of deal advisory for the Middle East and South Asia region for several years. Sir, it is our great pleasure to have, and we are welcoming some bank association. And with this, we are going to get your insights into valuations in Middle East versus India. Once again, and over to you, sir.
All right, Mr. Subara, first of all, thank you for your warm and kind introduction. All I say is that I have a reasonable idea over the last 3.5 decades working in the region, which is the Middle East. While I have some connect with India, but I may not be necessarily too familiar with the ever-changing regulatory and legal sort of rules and regulations around, even around valuation. So I will do my best to kind of give you a glimpse of what happens in the Middle East while you are better equipped or better informed on what happens in India. I have some contextual experience that I can kind of link up to, but perhaps, we'll start with the Middle East one. So first of all, I wish to thank the the Bangalore Valuation Association, who have invited me to this forum to share my experience. And I think valuation, as we all know, is the most subjective science, somewhere between saying whether is it an art or is it a science. And the reality today is it's even becoming a creative art and a creative science, to saying, what numbers mean. We have too much data. We have too much information. And issue is we are constantly called upon to make judgments based on all kinds of data that's thrown at us, right? Whether we are valuing it under different circumstances. Now, the other thing that we as valuers often are faced with is like saying, whose lenses are you wearing? As we say, beauty is in the eyes of the beholder, such is valuation too. So it's not too fair, it is quite fair to say that we are biased based on whose interest do we represent. But in any valuation, as I always say, the fundamental is neither science nor art, but it's really making the best use of information and looking at the purpose behind which a valuation is ever undertaken. And I know there is this concept of saying what is fair value. The fair value is always an interesting debate that never sort of thing. What is fair to A may not be fair to B, and we can all impress people with all kinds of methodologies that we could ever think of. But ultimately, everything has to be in the context of what are we trying to solve when undertaking a valuation. So what I will do is I would like to set some context as I start presenting in a minute or two about the Middle East. The reason I say that is I may have left the country many, many years ago and may not be too long before I sort of turn around the other way around. But people have a certain view of the Middle East, which unfortunately is neither true nor false. Either a lot of our Indian population think it's the glitz and glamour of Dubai, or it's the hardened and stringent rules of Saudi. The real story of Middle East, it's neither. The reality lies between the two extremes of how we view the Middle East. And I think I'll try to give you a glimpse, but also some comparisons to the Indian market will give you a context of saying, what is the environment and the data insights that we have in this region under which we seek to do valuations of businesses. So what I'll do is if I can share the screen, I hope this technology works for me because I've tested it, it should work. Give me a second. All right, can you see my screen?
Yes, sir, we can see your screen.
All right. What I will do is the first half of my presentation will be context setting, because before we just go into dive into the modes of valuation, what do we do here, what we don't, it can't be very different from whatever you do in India, except that the environment of what we have is information in terms of what happens in our markets, the depth or lack of it, and issues that are very specific to our region, determine certain things that we can do and certain things we may not be able to do. So I want to give you that context and set out that broad spectrum of information that will help you understand or perhaps appreciate. Some of you may know the Middle East well, so I apologize if you already know it very much, but still it'll be important to just set the context before we go into methodologies. So here's the key market insights that I want to share with you. And I want to pay a little bit of attention to, I'll just get myself a little off the screen, might help. Okay, for you guys to look at it. Okay, if you look at Middle East, I have put out there 16 countries at the top. You have Saudi, you have the GCC countries, which are only 6, which constitute Saudi Arabia, UAE, Qatar, Bahrain, Kuwait, and Oman. The other 10 countries, what you call North African region, MENA as we call it, Middle East and North African, include large countries such as Egypt, such as Algeria, such as Iraq, Algeria, and smaller countries like Morocco and Jordan and so on, and also includes Lebanon. Now, what I want to kind of set the context is it's a very vast region, and GDP per capita, I'll come to the absolute GDP in a minute, the GDP per capita in the GCC countries, for example, is closer to the average of 30,000 or thereabouts, or a little more. But even when I say 30,000 GDP per capita, you need to put it in context that even within the GCC, at the lower end of the per capita, you have Oman at about 18,000, and you have Qatar, which is north of 70,000. So what is average is again sometimes a misnomer, but just to put a context. Now, if you go outside the GCC, the average per capita can go very low. It depends on which country and the populations that there is. For example, Egypt's GDP per capita might be very low because it has a very large population relative to its GDP. And there could be other small countries like Morocco or Jordan and so on, where the GDP per capita is very low. Now, I want to the reason I'm setting this scene is you will see the context of where we talk subsequently when we're looking at the Middle East environment. Just at the bottom end of that table, I know the Indian GDP looks high, but of course, I don't know where we will land at the end of financial year 2021, but let's say, give or take, is the 2.8 trillion. Now, of that 2.8 trillion, I think if you look at the GCC plus the other countries, the GCC alone, when I refer to GCC, is the Gulf Cooperation Council of the 6 countries. That roughly is 1.65 trillion is the GDP of this bunch of countries, which is the focus area of our conversation today. I'm familiar, but none to sort of in terms of what happens in Egypt or what happens in Jordan or Lebanon and so on. I'm more familiar with what happens in the GCC world. Now, you will find that if you break that pie down of 1.65 trillion, 50% of that comes from Saudi Arabia. Whether you count it by GDP, whether you count it by population, I'll come to population, may not be in this chart, but to just give you a substance. 25% of the GDP comes from UAE. Of course, some of you would know Dubai, but then Abu Dhabi is where the purse strings are. There are 6 different unions within UAE, which forms the United Arab Emirates. They are 25% of the GDP. So essentially, if you take these 2 countries together, they represent 75% of the GDP. And then you have 2 other countries, which is Qatar and Kuwait. The numbers are a little bit around between them. They probably constitute another 20% of the economy. And then smaller countries such as Bahrain and Oman represents the 10%, or even less than 10%, probably 5 to 6%. So this is how it is distributed, and you got to put some context to the population as well. Let us say in the Middle East, for example, when I say GCC, you roughly have about 55 million to 56 million as the population. Half of that population or more come from Saudi, another 20% from UAE, and the rest of the population is distributed by Kuwait, Qatar, and let's say Oman and Bahrain. But what is different about this region as compared to other regions that you need to understand too, that if you say 56 million is the population, you probably have 25 million of that population who are expatriates. That means who are not citizens or nationals of these countries. If I look at the pure national populations of these countries, on it overall is about 30 million plus, right? The reason that becomes important is you would understand that subsequently when you look at some of the transactions and the average value of that transaction, in dollar terms, they tend to be higher. Because if you look at the per capita, and also when you break that per capita between the expatriate element and let's say the local element of the GDP per capita is much higher, right? Because although we contribute a lot to the GDP, but the GDP per capita of the what I might call as the expatriate population, if I say 25 million, you probably have, fair to say, 15 million of blue collar workers, and 10 million maybe the white collar to professional sort of people, right? Now, going beyond population, back to the numbers now. The GDP per capita, if you look at the GCC of 1.65 trillion that it is, almost 60% of that, 60% of that is coming from what you might regard as non-oil, and 40%, give or take, is coming from oil. Now, if you compare the same pie in terms of India, India is more diversified, no question. But then the services constitute a much larger proportion than essentially the two sectors where more employment exists, which is industrial and agriculture. Now, you don't see too much of industrial and agriculture. You'll see in a subsequent slide that I will present to you. But essentially, when I look at it, the non-oil sector, there's a lot of financial services, there's a lot of telecom, and certain other hospitality and other sectors which gain a lot more prominence in our region than perhaps other sectors. The reason I'm presenting this landscape is subsequently when I talk about market multiples, you will find that there are challenges which are unique to this region, which may not be necessarily true of what happens in our market in India. If I break this down in a sort of a little more sort of detail, if you look at, let's say, the India's index of the BSE all cap or whatever, that's roughly about 3 trillion, which is almost mirrors 100% of the GDP, give or take. Now, if you look at the MENA, which includes, of course, GCC plus others, but let's say GCC constitutes the bulk of it, almost 2.4 trillion of that 2.9 million or 3 trillion comes from Saudi alone. Obviously, there is an anomaly in that number because most recently last year, Aramco was listed on the local market, which is called the Tadawul All Share. They only listed about 1.5% or thereabouts of the stock. And they had the ambition of wanting to have to list the first 2 trillion company in this world. Subsequently, of course, the markets have corrected. They're probably close to anywhere between 1.6 to 1.65 trillion, depends on where you go. But what is interesting is that represents 80% of what is the Saudi market as well, almost. And then you have other markets, whether it's the Abu Dhabi Securities Exchange, the Qatar Stock Exchange, and others which add to it. So you get a very mixed view of how the markets are. And even in Tadawul, that is basically what I'm saying is the Saudi market, there's a very significant number in there coming out of Aramco, which is one single company. And that company's valuation is driven, I can speak about it, is just driven by the fact that they've assured a certain amount of dividend to be paid annually of $75 billion that enables them maintain that value. If that dividend assurance wasn't there for the next 2 to 3 years, this valuation may not be sustainable given where the oil prices stand right now. But going back beyond that, if you kind of look at saying, what does this comprise in terms of the emerging market index? Because both India and the Middle East sits in that index globally. India has moved up to about 8% of the emerging market index. But let's say this region is north of 3.5%, 4%, of which about 3%, almost 3.1% is between Saudi and let's say UAE, and the other markets virtually are 0.9% of the global emerging market index. If you look at another yardstick, which is interesting to compare the two parts of the world, India gets a lot of FDI, right? And more so recently with all these deals that are being talked about and bandied about in Reliance and elsewhere, GCC receives a much lower number, but then it is more diversified in a lot of energy and related investments and a lot of infrastructure monetization deals that are going on in the market, which produce large numbers where the government is selling some of its infrastructure assets to, if you like, large Canadian pension funds and other pension funds for income generation, like what Abu Dhabi has done, Saudi is likely to do. So some of this FDI is based on that, but directed at energy assets and infrastructure around that, which has been created over the last many years. There is one unique feature amongst all of this, which is unlike India, where you get sectoral representation in an index, the highest energy sector contribution of 40% is not necessarily in the listed markets, other than Aramco, which is an exception that has happened recently. So if I take nearby markets, be that it is Qatar, be that it is Kuwait, or be that it's Abu Dhabi and so on, these oil-related companies, which represent a significant part of the economy, there is no transmission seen in the stock markets, while movements in oil prices affect perceptions, affect expectations, but they're not represented in the stock market. So it's a unique kind of situation where oil price movements and stock markets, although they may go in a certain correlation, energy assets themselves are not represented in the index. If I kind of give you another element of a reference point for you, which is relevant between an Indian market and let's say the Middle East markets, if you look at the axes that might be, if you look at the y-axis where, if you kind of look at saying what is the average annual volume of traded shares, if you will, and this is based on the last 5 years average, so we don't get skew based on what happened in the last 6 months or 9 months. You got 17.5 billion as the average volume transacted in the Indian market. You then go along the graph and look at what's transacted in the regional markets, let's say in the Middle East. In Dubai, that's an average of 207 million versus 17.5 billion. Tadawul is about 170 million. And as you go down the graph to the far right, it is virtually a very, very small number compared to the context of what happens in emerging markets. The other interesting part that I think it's important to understand, in India, of course, you got too many listed companies. You probably have 5,579 at the last count, but this could change as we go along. But we also know in the Indian markets that maybe 20% of them trade very actively, and there's a lot of listed companies that don't go into the actively traded markets and are not followed or by the analysts or covered by them, or liquidity doesn't flow necessarily into them other than from passive funds. But if I kind of look at saying, if you look at the number of listed entities that exist in let's say other markets in the GCC, perhaps the best comparison, even if you look at Tadawul, which is the third graph there or the bar chart, you only have 200 companies listed on the Saudi market, right? And even amongst the 200, not all of them would be actively traded. Some of them will be traded and some of them will be relatively quiet. One of the features of our Middle East market is investors generally prefer to treat equity like a perpetual bond, which effectively means they are very dividend driven. Capital appreciation is seldom used as a basis for long-term investments. A lot of people buy stocks, hold. Trading volumes are only starting to improve, but nowhere near the scale of what it should be. Although there is a lot of free floating stocks, there are a lot of family houses in our part of the world which buy the stock, wait for the annual dividend, and the dividend yields, you will be surprised, is not bad at all. Some of the dividend yields are north of 6 or 7%, sometimes even 10%. So when you look at the low interest rate environment that prevails in the world, if you are getting a dollar return of 6 to 7 or sometimes 10, you're likely to be tempted saying there isn't much merit to sort of trade the stock. So we have those kind of unique issues which are very specific to our markets. But just to give you some context, as I said, in Egypt, for example, you got 222 companies. But if you look at the volume of trading, there's not much going on. Another feature which is not on the slide, which is relevant for you to understand, is the intermediation of the markets. In our part of the world, we don't have too many mutual funds, or we do not have a lot of institutional investors. There are some, but those are corporates. We have either the retail end of the investors, or what you might call the family-owned businesses, which tend to invest and is the closest proxy to an intermediary mutual fund, that they hold the investments, but don't essentially sell so actively. And you don't have active trading, but you don't have mutual funds and others. So therefore you get institutional coverage, and intermediation through mutual funds doesn't happen in our markets as compared to, let's say, the Indian markets, where you have so many domestic and foreign institutional investors. We have few than too many. Just another relevant piece of information that you might be interested to kind of put some context to what is the free floating shares in our markets. If you look at it in terms of free floating, the free float ratio is not bad, right? We've got 46%, 46% in India, for example. I know there are some companies which are not much of a free float, but if you look at some of the free float in other markets, smaller markets, but Kuwait is, let's say, the mid-sized market, has got 56%. Bahrain has about 55%. But a lot of them are family-owned investments, if I might say, although they are free float, it is kind of not actively traded. And if you look at the far right, which is the Tadawul, which I've just presented, which says the free floating stock is only 35%, but part of, or if it's free floating shares is rather 35 billion, but 13% is the free float because very large institutions, if Aramco is listed and it's only 1.5% which is floated on the market, you're naturally going to have this kind of skew. But this is again saying overall the ratio of free float is almost comparable to what exists in the Indian markets. If I'm going too fast, please stop me. I'm okay to take questions in between, but otherwise I can go through it and then I can take questions towards the end as you feel comfortable. Okay, if I may continue, if that's sort of, what this is. The other thing is also the returns of major indices in our markets. Now, the reason I'm setting all this context is because when you go subsequently to looking at what are the kind of market multiples we would use, what kind of numbers can we rely upon, sometimes you got to pay attention to this. This is not the mutual fund sale, which is say last 5 years, 3 years, 1 year, but just to put some context because the last 1 year has been brutal, more so the last 6 months, given where we have gone with the COVID and etc. So if you look at the last 5 years return and look at BSE all cap on the top, average is about 7.5% based on the 13 September set of numbers. But then if you look at last 3 years, it's only 1.9 and then goes to 5.2 if you look at the last 1 year, but it's there's too much money chasing stocks. So sometimes you don't know whether price and value mean anything. But anyway, if I come back to it and compare similarly to our markets or regional markets in the Middle East, if you look at the GCC numbers, if you look at Kuwait on a 1 year basis, it's negative. Bahrain is negative. Abu Dhabi is negative. Qatar is negative. Jordan is negative. Dubai is negative. Tadawul is marginally positive at 5.5% largely because the share price of one of their key stocks, Aramco, is maintained on the basis of the dividend promise that was made when their IPO was done. Now, if that were not to be the case, even this index may not have maintained the 5.4%. But the average returns, if I look at 5 year kind of average, obviously the Indian market outperforms, if you like, the returns that you get in sort of, the GCC markets or this, barring of course Egypt, because it's a very volatile market, Egypt is. And Egypt's markets, while this might be the kind of return, you have to understand Egyptian interest rates are very, very high. Whereas in the GCC, all the 6 countries, the currency is pegged to the dollar. So everything moves alongside the dollar in terms of saying the currency peg has remained for as many years as I've been around in this region. There's always the talk of saying if the currency peg moves, what will happen? But right now there is no reason why the currency peg is expected to be changing or whatever. But to put it in perspective, the dollar return gives you the stability and the interest rates are mirror what happens in the global world. So therefore, if you look at it, Egypt is slightly higher in terms of index returns, but then their interest rates are very high as well. Now, the COVID pandemic has affected all our markets, no different to saying what happens in our market versus one market to another. But essentially, there is a serious correction. And unless economic activity comes back to some regaining of strength or momentum, you cannot expect some of this to sort of in the short run turn around and go back to wherever we were. I've been listening during the course of many valuations and many pundits within our region and outside, who's, if you ask anybody saying, what do you think 2021 is going to look like? Now, the most optimist person based on, whatever insight or knowledge that they think they have on caveated by saying, when will the vaccine ever show up? Will tell you that 21, we might be 10% short of 2019, if you will. 2020, people have almost given up and written off, saying we're all going to be in for a huge shock in terms of where the financial year ends here at December, and like our tax year ends in March. But let us say 2021, the view is that if the world were to regain momentum Q1 2021, you're looking at saying we'll still be 10% short of 2019. But if you look at some other realists who say we'll be lucky by 2022 to get closer to the 2019 level. The reality, of course, is too early to tell. And I know many people have predicted the future, and every time they have done so, they only learn from experience subsequently, because in a rear view mirror, a 2020 view is perfect. I kind of want to talk about the market capitalization by sectors, because this is another important element that'll be of interest to you guys. As I said, the Bombay Stock Exchange, or the BSE that we know, its distribution of 2.9 million is also interesting. When we presented the earlier GDP slice of how it is done, there is a certain amount of mirroring between what this sector in the GDP represents and its transmission through the stock markets is equally well distributed. Although here, we don't have too many agricultural companies in India yet, but who knows, it might come with all these reforms that we're talking about. But if you look at the same thing, I want to make a distinction between Tadawul, which is obviously the Saudi market, and other indices, which I would group the, let's say, the GCC markets other than Saudi. So if I look at the middle piece of what you might regard as saying, if you take the total of, when you compare India to the GCC as 2.9 trillion, 2.4 trillion that represents Saudi, 80% of that 2.24 trillion, almost, as you might say, close to 2 trillion, is coming from energy sector, which is really Saudi Aramco contributing probably 1.7 trillion. And then you have other companies that add up to another 300 billion, which are services oriented around the energy sector, whether that's SABIC and so other companies. Now, if you then look at what are the other sectors that matter in our region, you got financials, you got communication services, and some amount of materials, which again is probably include some amount of industrials, if you will. But if I remove the Saudi out of the equation and compare that to what happens in the other GCC markets, you will find that financials and communication services almost occupy 60% of the index. And then if you look at the other sectors, which should have been more represented, energy is only 12%, but when we looked at the GDP slice, that showed 40%, which is where I said the transmission between the GDP sector and its representation in the stock markets is not there, simply because those companies have yet to be listed, or they are not in public markets. They're state-owned companies and run with strategic intent of how they would like the energy prices to be taken advantage of or controlled with, and so on. But it is changing. If Aramco is listed, I will not be surprised in the next 3 years, you're likely to find more energy companies coming in the market one way or another. But this is just to set the context of what I'm about to say. This is not to kind of tell you that you would not know this information, but essentially the CAGR returns by sector, which again influences the outlook on growth rates when we do valuation, is about saying, look at the CAGR returns in each of the sectors. What is interesting perhaps is if you look at all the losers in our market, in our market, if you want to call Bombay Stock Exchange, it is actually the other way around, where there are gainers in the same sector in these markets. So if I look at, for example, consumer services is down in the Saudi market by 16%. Whether I call consumer durables includes consumer services, in India, it's gone up by 17%. So there is a little bit of what I might call inverse correlation between the two markets, because naturally we are an energy consumer, and this part of the world is our energy producers. Any decrease in oil prices have a direct correlation to the perception, to the returns, and to the economic environment in these countries that then affect stock prices, asset prices, and so on. Any price reduction in the consumer market like India is, it obviously means there is saving and wherever those industries get impacted, but that's not the only reason, but just to give you a context sort of comparison and to say there is an interesting inverse correlation between the two markets. So if people are looking at dividend play and stable dollar returns, sometimes it is also a great idea to look at these markets, and is happening to the extent the recognition even in the emerging markets index has only happened in the last 2 years or so on. Earlier, these markets were not even recognized in the MSCI index at all. So they were completely on their own, but they had to go through a lot of reforms, changes, whatever needs to be done on the T+3 settlement and the systems of clearances and clearing houses and all that, which has been sorted out. So it is bound to improve over time as more funds start to come in from outside, and the regulations for foreign ownership is also changed. I want to kind of quickly run you through a couple of stats, which is again of relevance and importance. Of course, in an Indian market, the IPOs in terms of whether we talk of values, which is the chart in the blue, and they're all in $1 billion or $1 million as you might read it. And then you look at the number of IPOs in terms of transactions. On an average, the amount of IPOs that take place in the Indian market is very huge. And more so recently when there's so much money being flooded in our markets in India. There's a lot more IPOs coming in to take advantage of this window of opportunity. However, the average size of the IPO in an Indian market, give or take, is about $70 million. It's not perfect, but roughly. Whereas in the Middle East markets, there are fewer transactions, but the average size of an IPO is north of about $150 million. Just remember the Aramco IPO is a complete outlier. It doesn't go into any of the standard deviations you might look at. It's way outside the norm. But if you take away that, the GCC economies, the number of IPOs have been very few, and lately almost kind of limited, as I might say. But the size of the IPOs or whatever have come have been reasonably sized, and the average size of the IPO is in that sort of range where a reasonable amount of funds have been raised to regional and international markets. But let me kind of quickly race through into the remaining part of it, and then we go into the valuation methodologies, which is what is the core purpose of this exercise. I'll leave you with the transactions as well. One element of the M&A activities in the last 5 years in our region, which when I say our region, let's understand the two regions. If I look at the one on the left, which is the India market, you've had almost 8,000 deals, give or take. And as the rainbow chart indicates on the left, across multiple sectors, although there is some skew on the communications deals, probably represented by the recent range of transactions in this, whether you classify that energy or communications, I do not know, but let's say there's a huge amount of activity around that sort of space. But the average deal size of that investment is about $50 million. As opposed to, let's say, you got only 25%, less than 25% of that volume in terms of volume of deals in this market, but the average deal size is about 210 million. It's a bigger deal size on an average. Individual deals, you may have the exceptions like Aramco here and maybe Reliance in India. Those are the outliers, as might call. But there's a lot of consolidation going on in our region as well. One unique feature of the Middle East that some of you may not know, most of our institutions, whether they are in the financial services sector, whether they are in the telecom sector, which is an actively traded market, or services or hospitality, they tend to be a lot more national in the sense that Saudi has more local banks than it has a regional bank. Similarly, Kuwait has its own regional local banks with very little regional footprint. But what is changing is there is a lot of cross-border activity that is coming in these areas where now they know that regional presence, scale and size is going to be critical to be able to compete, invest, sustain, and remain in business. So we are seeing a lot of national as well as regional consolidation in some of these markets before you're going to see large amount of foreign investor interest, because for them, the 6 markets together will represent a lot of investor interest. Individual markets other than Saudi and perhaps UAE, there will be limited appetite unless there is a certain element of specific reason to sort of aggregate the business as part of their strategy to build out for a future exit. But I don't want to dwell on this. I also just one last quick thought, and then I'll jump into the core of the presentation, which is how the analysts cover us. One, you have known that we've got fewer listed companies. Naturally, you've got fewer analysts who are tracking and producing research. Now, with fewer tracking and research, the volume of trading is also going to be limited. And then we don't have too many institutional investors beyond a certain level. So therefore, it's just to put that in context, saying you can't compare the two markets, although the numbers are comparable, but the characteristics of these markets are by no means are necessarily comparable. Okay, let's now get into the meat of the discussion, which is what I will kind of summarize before we get into the actual methodologies, if you will. So if I look at the little kind of dashboard that, if you want to call it, in terms of where the meter shows you, if I look at the various characteristics on liquidity, the liquidity on the left in the MENA markets is not very sizable. They're relatively lower volume of trading, other than say Tadawul to a certain extent, or Kuwait to a certain extent, and in some stocks in Qatar maybe. But other markets, the volume of trading or liquidity chasing stocks is rather limited. So if I look at the volume weighted average price of stocks, you might get a different picture from looking at sort of numbers based on multiples of PEs and other stuff. If I look at the other opposite to the spectrum in India, there's too much money, as I said at the start of the conversation, chasing anything and everything. And as a result, sometimes the money drives the momentum and momentum drives price. Whether price is value is always an interesting debate, be it India, definitely in the Middle East for sure, where everyone thinks price equals value sometimes in our market, and we struggle sometimes to be able to explain that price is what you choose to pay, value is what you get and what it's worth. And unfortunately, the convergence of those two happen in a stable equilibrium, but unfortunately, that never is the case. And there's always a divergence, and sometimes most of our judgments we make or the way we choose to sort of tell our clients is for them to understand the difference between the two. Now, market depth, no question, India has got a deeper market, although it's some representation even in India in the context of what it has is overly concentrated in the top 20 or top 50, as opposed to saying we got 5,900 stocks. It's still got some way to go from the small cap, mid cap to sort of go up in terms of the diversification you need. Market depth compared to that in our markets is kind of saying is a challenge. And if I look at the returns environment, it is like saying on a dividend basis, the returns in India is higher. And when I say dividends plus, it's the total shareholder return. So I talk of the total shareholder return, which is the dividends plus the capital appreciation. Whereas in the MENA markets on the left, you can say that it's more dividend driven, as I said. And there's capital appreciation is if there is no volume of activity, liquidity, then you're going to have price effect on those stock prices. Market activity is in the lower end compared to India. There's too much, as I said, too much of institutional and retail investors. I'm told that millions of people in Corona have chosen to open demat accounts. Maybe it's a pastime or it's a risk they have chosen to take while it's a pastime. Time will tell. And we have gone through these cycles where a lot of retail investors have burned themselves, but that's not the conversation for now, but chasing everything based on a liquidity rainbow. M&As, lot more interest given the growth opportunity in the Indian markets, and relatively smaller but focused M&As, cross-border consolidation in our regional markets. Let me come to the core of the presentation. I'm sorry that to set the scene to drive you through what valuation methodologies are or how we choose to sort of do it in our markets, Middle East markets. Obviously, in any valuation scenario, we all are familiar with, and all of you being valuation experts, I don't need to kind of preach to the converted, that we use discounted or cash flows and income-based methodologies of all kinds. CAPM is one of the more commonly used one, but there are a lot of fallacies and concerns we need to be careful with. Comparable companies is always interesting to know, but what do you compare with if the data insights are rather limited or it has its fallacies that you need to be careful using this. which is why at the start when we talked, is it an art or a science? It is like saying there's a lot of judgment that we need to make. All of us valuers know that not all the data is just cooked and is formula based, nor is it simply based on views of the future. The reality lies in between data from the past, present, and the views on the future. As far as the real estate, it is the RICS global valuation kind of standards that are applied in looking at sort of the real estate valuation. I'll give you some glimpse of what do we mean by different multiples and methodologies. If I look at, let's say, just comparable multiples, the common standard stuff that is used in these markets is price to earnings, trailing, or sometimes implied on based on forward looking sort of numbers, price to book. But price to book is an interesting one in these markets because most of the deals that get done on price to book is based on saying what kind of returns on equity are they getting, and therefore is the book worth what it is. Because the notion in the Middle East in the past, and some of it even today in the family owned businesses, hasn't changed. It's very simplistic, but you'll be surprised when you actually do the math later and check it out with whatever DCF you do, is they had a conventional way of back of the envelope calculation. They used to simply say, take the 3 years average profit for the future, add it on top of the assets, and that is the value which they would call as goodwill on top of the assets. Totally unscientific, I agree with you. And it's not the best way to do it, but this is the kind of simplistic the world used to be, to becoming a lot more sophisticated, using a number of multiples from which you derive the implied, not using the secondary market reference to derive valuation. Now, price to sales is a very interesting one, right? And that is more evident in an Indian market, perhaps hasn't percolated down to the Middle East because India gets a lot of these technology bursts of valuations coming in from the Western world, particularly the Silicon Valley, where Apple and other companies are all valued on price to sales. If I look at Tesla, I don't know what does PE mean or price to book mean, but price to sales is how they look at it, saying it's only valued at 8 times sales, 10 times sales. I shudder to think if we started our valuation careers in the current times, what are the new multiples that we will be learning in the future, because everything is on a bet on how the future is going to be, that you will be way ahead of the competition, you have unlimited growth, you have the ability to influence prices, and therefore all that growth is being priced in today. But funnily enough, such momentum thinking still make returns for the traders. Is that a long-term valuation kind of play? If we were to do an intrinsic kind of valuation, we will always be skeptical, as we might be using our lenses of the traditional valuation methods. But price to sales has even crept in an Indian market. I recently kind of happened to read something on price to sales in relation to one of the Jubilant Food Works, or what is it, Jubilant Food or something like that. Now there again, they talk of price to sales is only 8%, 9%, but we financial guys who know that sales is a great number to have, but ultimately after you pay for and deduct for all the costs, you only are left with the margins and the net profits from which you pay dividends and reinvest from the EBITDA to saying your capex investment, to say is price to sales a reasonable multiple or not, but it is beginning to creep in from technology to other areas as well. EV to EBITDA is a common thing that everyone uses and understands. But again, these needs a careful amount of analysis, because what happens in our part of the world is when you look at trying to get comparable numbers, you have to do enormous amount of research to be able to isolate the what I might call the outliers, and also bring the data set to being relevant to context, because the size of some of these deals have no relevance to some of the work that we might be doing in our region. And therefore you'll need to kind of use those data sets which represent very closely how you would use that as a reference point. It's always a secondary check. We have known some of the sort of valuers in our part of the markets where they kind of use this kind of methodology, which they say, let me do the intrinsic valuation using DCF and those kind of CAPM models or any other Gordon growth or any other models, and then take 1/3 from that, 1/3 from market multiples and that kind of stuff. Typically, you would not do that, because the markets only, you cannot average a primary and secondary basis to do that. That's our view. But again, I'm saying there is Sometimes this averaging kind of helps present an argument. Is it the most scientific way of doing it? Perhaps not. But at the end of the day, when you do a valuation, you're trying to justify a number sometimes. You got to be careful because most of the market multiples are forward-looking information, and most of the intrinsic value is inherent proprietary information, and price is based on expectations, whereas valuation is based on forward-looking numbers with the kind of detailed analysis and so on. So we tend to stick a lot more to the intrinsic value while we use the secondary multiples as a reference check, not trying to average numbers and trying to present a basis. It's not to say that's right or wrong. One can use it, one can be questioned, but in a very scientific way, you wouldn't merge the primary and secondary basis to do a valuation. The real estate valuation is again what I might call the cap rates kind of approach with the RICS methodology on looking at rental incomes and costs and whatever. Now, funnily enough, the real estate market in the Middle East is the rental yields are pretty good because unlike India, where the asset prices for real estate, the rental yields, you'll barely get 2% in some cities, maybe up to 4% in some other cities. So the real estate prices are way higher than the rental yields it generates. Whereas in our part of the world, in the Middle East, the real estate valuations are more modest and the real estate yields are far better. Now, in some cases, the expectations can be even 10%. Now, to get 10% yield on real estate is not very easy in other markets, but here in the residential real estate and sometimes even in commercial real estate, 8 to 10% is not considered unreasonable. I want to kind of present a few thoughts in terms of saying there is no uniform, I would say, uniformity in the valuation dynamics because of limited local guidance. There is no specific valuation guidance that is given in our markets to say you have to do this or you can't do that. But if I go back in history, there used to be a time when any IPO was priced, we were called in to do a valuation, and we had to go to the government authorities to be able to justify the valuation because the government authority was almost like a SEBI body or what used to be the earlier capital control, sort of a capital controller of markets that used to exist, right? CCI or whatever it used to be called and gone now. They used to be almost like trying to be the gatekeeper, trying to say you should price your IPOs at a certain value. The concept of book building and all never happened till much later. Now here, there are no regulations as yet for the business valuations, while they are all moving to the IVS standards to be applicable over time. Another feature of our market you have to understand is to get risk-free rates in our markets, we don't have an active bond market. So we have only a sovereign bond market. We have no corporate bond markets, and bonds are not necessarily traded in the market actively for institutional and retail participation, other than a few sovereign issues which are slowly beginning to come in. I'll come to how we derive some of this math when you look at saying, you know, how we do these things in terms of the CAPM model and so on. The other interesting part of our markets is people, when they present their future, always present a hockey stick. I'm not saying India doesn't. India also presents a very sharp hockey stick where people have a greater view of and hope of the future, but less to believe in terms of what exists in the present or the past. But unfortunately, every time we are called in for evaluation, depending on the lens that we wear, whether we're looking at it from a buyer's lens, a seller's lens, or we're looking at it from a regulatory, which is like an independent view, we have to have skepticism. What we find in our markets is we don't tend to argue too much with the owners who are presenting or the promoters saying what they present. We do an alternative financial model, which we don't essentially take necessarily whatever is presented with our views on what we think is a more realistic case. Because if you are going to sit down with the promoter and get the projections to where it should be reasonable, I think a debate is a never-ending process. So we don't get into those positions. We do alternative models. We do sensitivity analysis of all kinds. And I know that at the end of the day, I'll come to the terminal rate when we talk about the CAPM model in a minute. Now, market risk premium is also an interesting one because if you don't have an active bond market, where do you get market risk premiums in calculating your WACC rates? So we do a certain way in which we maintain consistency, and I will show you what we exactly do so that we're able to kind of put some context in determining the WACC, if you will. The other part, which is a unique part in the Middle East and to a certain extent perhaps in India, is you guys don't use so much of alpha, right? You tend to say the discount rate inherently builds all of the elements, whereas in this, we build a certain amount of alpha because we look at the risk of the quality of the cash flows. We look at some of the challenges the business in the economic environment it's faced in. So we tend to build a certain alpha because most of the return metrics that we use come from other markets that can't be directly and easily translated to local markets. So we use a little bit of element of judgment, and that affects the discount rate. And comparable companies, as I said to you, is again using a lot of data sets, which again has to be brought down to what might be relevant to the field of play, because there are too many data sets. And every time you present something, you'll always get a disconnect between the expectations. We always use medians. We never use an average because the average is never representative. Just like the GDP, I said one country is 800 billion, somebody is at 30 billion. So what's the average represent? It doesn't mean anything. I'll just show you the breakdown of the CAPM model that sort of maybe explains some of the stuff. So if you look at the cost of equity that we tend to calculate in our markets, because ours is linked to the US markets in terms of saying it's a stable exchange rate model. So you start with the US Treasury rate because that is the most actively traded risk-free rate. From that, we then determine what are the country risk premiums, which again is the credit default spreads based on ratings that we kind of use as a kind of a part. And these are published information, so there is nothing magical about it. So we use what is the compensation for investing in an emerging market, which changes, of course, by country, by time, which happens. The equity beta, because again here, the equity beta we get from traded and other multiples, and we use the market risk premium, which is coming from what you might call as saying the differential between bond and equity returns in other markets, which we then bring it down to our markets to compare that risk. We have to adjust for size premiums because some of them are very small. And we also have the fact that sometimes we're valuing a lot of low floating stocks, or for that matter, private companies, so we get the illiquidity part of it. So there's a lot of judgment, as you can see in this equation. It's not a simple arithmetic. You create the WACC and the back is a magical number. You'll have to, at every stage of this equation, there are judgments and there's a back check. What I want to do is to kind of leave a few thoughts on what COVID has done to all of us. Now, one of the things is the oil prices have gone down dramatically, and that's causing liquidity pressures in our markets, both in the credit markets and the stock markets. So we are going to have new risks that we have never witnessed. In 6 months, we can see the feel it, and there's going to be a lot more to come as we go into the financial year end of banks. For example, we anticipate, and I'm sure it's no secret, that is what is being published by S&P or Moody's or Fitch or whoever, that there is going to be a credit quality deterioration in our markets, where banks have asked to be given moratorium to their borrowers of all kinds. There are a lot of restructuring that is coming in the marketplace. Asset values, because of the lack of liquidity in the markets, be it stocks, be it real estate, whatever is getting affected. So there is no easy monetization options either. So we're going to find a lot of painful restructuring, that means if corporate balance sheets are affected, then banks will be affected. And in effect, that will stop up in the markets as well. There is one element which is interesting in our markets. The interest rates, naturally, because the monetary policy is directly dependent on what happens in the US markets. The interest rates are considered low compared to what happens because it depends on the rating of each of our countries in the GCC is not the same. Some of them are investment grade paper and some of them are sub-investment grade paper. So you are going to get very varying kind of levels of pricing for credit. But if you compare that to what happens on the ground, the interest rates are not necessarily the lowest when lending takes place to MSMEs or corporates, simply because the price of credit to banks based on their own borrowing costs and the cost of credit losses, which is the expected credit losses that these guys have to kind of work and prepare themselves thanks to the IFRS 9 world, which have to be passed on to their customers. So at the end of the day, we don't find necessarily the credit costs have come down, notwithstanding the interest rates going down. So it doesn't mean our WACC rate has suddenly gone down because the global interest rates are somewhere around 0 or 1 or some places negative, but that's not necessarily the case in the GCC. And also that we have challenges on the operational risk. So when we look at the alpha, when we look at these issues, these are some of the things that we look at when we look at the alpha judgments. I want to leave you with a final thought on some of the valuation issues that we are, the characteristics or attributes that I said. The Middle East or GCC in specific is a very dividend-driven market. So the value of growth and future is on shareholder return on capital appreciation is not well priced in. We need more institutional investors to come, more index tracking to happen, more passive money to come in, and regulations to change. And one of the things I say, I know this is a forum, but may happen in due course over time. If the GCC markets, or stock markets, I might say, if they were to be combined in a single stock exchange, not necessarily individual stock exchanges, it might change the game dramatically. Is that going to happen anytime soon? It hasn't happened in all these years, but looking at the momentum and the change, who knows, we may all be surprised over time that it may happen too. 75% is only 2 markets. If they get together, the rest will follow. Now there's lower diversification across the sectors, which we know there is over focus, if you will, on some sectors, and some sectors are not even represented in the markets. Bond portfolio is only government bonds. We don't have corporate bonds or other bond markets, and they're not actively traded either. As I said, there's a disconnect between the energy sector, what remains in the GDP, and what is transmitted across the stock markets, barring Aramco. There's nothing that has happened. And the new growth sectors, which is represented in India in a long while, which is digital and technology, is not yet visible in our markets. Might happen, but we don't have the typical the billion-dollar sort of IPOs coming up from services sector or technology sector. It's early stages of development and the scale of the markets where we might see some, but nothing in terms of the unicorns that you see back in India, if you will. Now, Indian markets outperform this market, but the dividend-driven kind of market, if you look at it on a pure yield basis, this is an interesting market to be looking at. Limited IPOs, as I said, and limited visibility on investors in our markets compared to yours. M&A activities, more consolidation play, regional and local, whereas back home it is more international investors that are coming in looking at opportunities for future growth, a huge amount of money from the PE world and institutional investors beyond the PEs. We don't have LBOs and MBOs in our market. They're very rare because we don't have too much of acquisition financing like the West, which is willing to sort of take a huge bet on doing LBOs or MBOs. Maybe in time, nothing that's happening in the market. I want to kind of say I've spent the last almost an hour and just kept rattling away from my speed. Apologies if it's too fast. But I'm happy at this point to just step back a little bit, and then maybe I have only 5 minutes to tell you about the insolvency side of it. But maybe if you guys have questions, I might just take a pause and listen.
So just one question here. Am I audible?
Yeah, you're audible. Yeah, please go ahead.
What's the taxation, both on the corporate taxation and individual taxation front in the GCC? Because I don't know too much about it, but I did know that personal taxation was virtually non-existent till the oil prices crashed and all. So when you're talking about yields of 7% and 10% and all, and also from a valuation perspective also, how does the taxation or the absence of it drive cost of capital and expected returns and all in those markets?
Sure. Yeah, fair enough. Fair question. Corporate taxes of certain kind have already existed for foreign investors in Saudi, UAE, not UAE, perhaps Oman, and Qatar, and a little bit in Kuwait, perhaps not. But those corporate taxes are not very significant. You do not have slabs. It's a more simplistic system of corporate taxes, and they're at a very low rate, if you will. Some of the GCC countries, like you said, do not have corporate taxes, such as Oman, to an extent Kuwait, and to an extent even UAE. What has come as tax in our region is only been in the last 2 years, you might say, which is a value-added tax, or the equivalent of yours is GST, right? And there again, it's more a flat structure. It started naturally with the lower end of the thing at 5%. In the last few months, for certain category of goods in Saudi, they have moved that 5 to 15. They are reluctant, as I understand, not that I know anything can change, as you said, whether more corporate taxes is to come or the rates will remain the same. But they know that it should not deter foreign investment, or also you have to understand, we've got a huge amount of foreign labor here. So if there are personal taxes or corporate taxes beyond a certain point, it might impact that market too. So they are maybe considering, not that I know where it will end up, but I will not be surprised in the next 2 to 3 years, certain element of corporate taxation will go further from where we are if the oil prices remain as at the current levels or marginally above these levels. And personal taxation is not impossible to think of, because personal taxation doesn't exist at this moment in the GCC.
Ram, Gopal here.
Yeah, Gopal, go ahead.
Yeah, just on the tax bit, and what I can add is Oman is the only country which has got tax for even local companies. Out of 6 GCCs, 3 other countries, which is Qatar, Saudi, and Kuwait, have got corporate tax only for the foreign element, which is non-nationals, for non-Saudis or non-Kuwaitis and non-Qataris. For share of profit is taxed at a certain rate. So just to add to the question which somebody asked. Yeah, thank you.
Thanks, Gopal. Thank you. Any other questions or?
So what are the impact of this is the cost of capital, sir? So is in the absence of tax, the tax shield not being there, so do investors, the distinction between equity and debt, except for the the risk part and the residuary income part, that part aside, there's no, I assume there would not be many tax-friendly reasons for people to prefer debt or equity, correct?
Yeah, I think tax-friendly reasons, you're right, because the tax shield is not what it should be in other markets that you see. So that is why some of the concepts like leasing and other things haven't kind of gone into a great spin, if you like, in our part of the world, right? Financial leasing and so on, which is an industry that would crop up with more tax kind of situations. We don't have any of that, but over time it might change. We are at the cusp of saying those are some of the economic policy issues that I'm sure will be under debate.
Okay.
I have a question.
Please.
Valuation is now a regulated profession in India. There has to be a qualification, like the other day I was sharing with you, registered valuer examination, and penalties also are have been levied now. Provision has been made in the law to penalize a valuer for whatever misconduct or wrong valuation report. Like that, what is the position in Middle East?
Okay, fair question. It's interesting. Now, as I said, the real estate side is largely moving to the RIC standard. Let's say the valuation standards are more IVS, or whatever we call international valuation standards, that they are trying to sort of impose, largely looked after by the regulatory agency, which is the capital markets in each country. There is no standardization as yet, but increasingly more valuation specialists in our market are obviously a lot of chartered accountants for sure, but also a lot of CFAs who have come to the fore in the last 5 years, I might say, right? Now, is there a formal regulatory framework for valuation association or valuation professionals to be recognized? Not yet, but not surprising saying it should not happen over the next 3 to 5 years. Any other questions?
Sir, I want to continue that question of Shilpa. Initially, you mentioned that it's an art and it's a science. I just want to know whether it should be legal also, the valuation profession. I mean, how do you? Because so far we know it is only an art and it's a science, and you bring in legality into it, and it takes away the art and science is what I feel, and it should not be compromised on the art and science. It should be allowed, because you explained how the market dynamics plays vis-a-vis India and GCC, how the outliers play a role and the inliers play a role. So inside of all these things, why do you want to regulate a profession which is an art and science?
See, the point is, you're fair. For example, if we go back in our own history, if you might, over time, we had that controller of capital issues, right? Which was the old gold standard for valuation references, if you will. They tried to be prescriptive on what should be done and how you can do it. And they found that they became irrelevant in the context of where the markets had moved and the way the needs of the capital markets is. Now, unfortunately, having said that, there is still some amount of oversight and kind of thought, not that the methodologies are being prescribed, but you do have, whether it's the SEBI or other agencies which keep an eye on the basis of valuations. Here, for example, the Capital Markets Authority in each of our countries, whenever we do a valuation, not only have we to present it to the companies or the boards that we have to do the valuation for, we have to go and explain ourselves to the regulatory world. For sometimes they may or may not appreciate some of the computations, calculations, judgments, irrespective of whether they agree or disagree. We are invariably having to sort of go to present to convince them of the basis of whatever we have done. And this is not defined in law, but more in terms of saying that they want to see that independent process have taken place and there hasn't been undue influence in arriving at numbers. Okay. I'll just take 5 more minutes maybe, and then kind of this thing on the insolvency, because somebody said insolvency between the two markets. I'm none too familiar with the Indian markets, but I know we've got guys who understand that a little bit from the Indian context, because India has moved a lot on the IBC and all those kind of regulations. First thing that I want to say to all of you, are GCC markets, when it comes to bankruptcies and insolvency regulations, are at the very nascent stage of introducing such regulations. Some of these regulations have only been issued. For example, Bahrain has issued one, Saudi is working on one, and other countries are thinking. A lot of that would mimic in some way what I would call the Chapter 11 kind of approach, if you will, right? To protect the companies to work out and form from creditors and all that stuff. But one thing is to pass the regulations and get that to speed. The other thing is I would say the infrastructure for the implementing this idea is still at a very nascent stage. So I'll just give you some headlines, not to say it's a very extensive topic, but I would regard as saying, if I look at where the world is and what might happen next year, this need for using this framework will only be tested when we get a number of use cases on bankruptcy proceedings and so on, because banks have not been used to it. They hate the word haircut, restructuring, and they exert a significant amount of influence on the regulatory world. And the regulatory governance framework on the creditors' rights are still hazy. How do you form governance committees and others to ensure that the operational creditors and the lenders' interests are aligned, or one is kept senior to the other or not? How do you keep promoters from getting involved in the continuing part of the business? Are all issues that are not being tackled as yet. But the experience of that is about to happen, I would regard, in 2021, starting where this is more going to be prevalent than we have ever seen. So it is at a very nascent stage. Neither the regulatory framework nor the legal framework infrastructure to make this happen has been fully created. It's exploratory at the least, which is why you see this ice caveman trying to sort of break ice. It's at that stage. I just kind of not sort of rest on that sort of picture, but just to kind of give you a sense of saying, the process is obviously, everybody knows you want better recoveries at less time and lower cost. If you look at the international one, if you look at the one on the bar chart at the top right-hand corner, you would see that the recovery rates from insolvencies in other countries, be that be in Finland, which is as much as 88, or Norway at 92, or even Japan at 92, disciplined countries where laws abiding and the system works as it should. And then when you look at, let's say, UAE at the far end, recovery rates as bad as 27.7. The problem is that when you have such low recovery rates, not many banks and other institutions are too happy to go down the path of bankruptcy and work out, because they feel that the systems and the courts and the way the infrastructure being set up for the recovery to work, and to minimize the interference or perhaps involvement of the owners or promoters who have led this company to that state, is still influenced quite heavily, and therefore it is work in progress to saying it might come over time, not yet. I've just kind of given you some headlines, not important Bahrain law, but essentially saying we also have issues here in terms of saying what is realizable value. We don't have an active market for secondary market sale of assets or buyout of portfolios, if you will, when on liquidation. But these will all get tested. It's early days for me to suggest saying, these have all been tested. The law exists. It hasn't been kind of put into practice. And a few test cases will be visible as we see coming in this market and certainly in other markets, because the pandemic has had very serious effect on some of the businesses which might go down this route. Just a comparison, nothing much other than saying the law in India was passed in 2016, but it has moved on significantly from where it was, and it's getting better, because if I just take you back one slide and show you that the India recovery rates are almost 72% and improving with more and more use cases, more and more resolution of legal issues that were, and also building out the framework and the regulations and so on. Whereas here, the law has been framed, but all of the other pieces that are required in the jigsaw puzzle, including insolvency professionals who have to come on board, and the legal systems of how this can be arbitrated or resolved, those mechanisms have still not been implemented. But I would regard as saying we're 3 years behind the curve, but there will be a catch-up if I put it in the context of 2021. But I just wanted to present the headlines, not to say this is a valuation theme beyond a point. And this is just a comparison between the India and Bahrain one, but it is pretty similar in outlook, because this is, India is of course tailored a lot more to what happens in the context of our markets. But the debtor in possession model, as we say, here is a concern. Whereas in India, it gets kind of taken away and then there's minimal involvement, whereas that is not possible as yet in our markets. But I see that happening, and nothing in terms of major cases that have taken place in our market as yet. So this is just the headlines of the insolvency market and valuations, but we are in a nascent stage, and the need for it and the use of this framework would happen anytime in the next 6 months when this gets going, if the current environment prevails. So I think that's not to kind of say anymore. I just wanted to give you the headlines, but I've said a lot in the time you have. I'm more than happy to take any other questions in the context of, you might educate me on the Indian market, as I've tried to tell you what I think I do know of the Middle East markets. Thank you.
So are all the Middle East countries using IFRS as the accounting standards, or is there any disparity?
Okay. Let us put it this way, that all the GCC country except Saudi are on IFRS, right? Saudi has also its accounting standards. It's called Saudi's, I don't know the full word, but anyway, it's called a Saudi accounting standard, right? SAS or the equivalent. But a lot of that draws inference from IFRS. So it's not perfect IFRS, but it's a proxy where it's almost similar in terms of build-up, but certain subtle changes which are there, which are not essentially one-to-one alignment with IFRS. Otherwise, the other markets are all on IFRS, yeah.
Hi Ram, this is Sumit here. I have
Hi,
been
Sumit.
part of KPMG Bahrain for 5 years in 2010 onwards. So just one question, since I'm based in India now. At times I understand that a lot of entities in Middle East get evaluations done from Indian professionals based in India. This practice still continued, or globally the people are now looking for local values only, because the emphasis of the government is more on locals last 2-3 years across the GCC. So,
Yeah.
like for example, Betelco and all. So, if you can
Yeah.
throw some light on that.
Hi, Sumit. Hi, Sumit. At the end of the day, it's horses for courses, if I might put it in a rough way, Sumit. It's some private companies, or sometimes where an asset valuation is done for the purpose of some compliance part of process, not transactional. They might be okay to get this valuation done externally because they say this is what they do and they follow that sort of principle. Whether it's a cost arbitrage or they look at it saying that meets the standards and they're happy with sort of doing it. Now, those are compliance processes, banks and other places. But when you come to local transactional valuation, you have to go in front of your boards or your regulators. Then companies are going to find it more hard pressed to necessarily use valuation specialists from outside, unless they have local presence and local insights. It's not to say they can't do it, but it is more difficult, and therefore there would be a lot more leaning to use local valuation professionals. But do you need to register yourself with the any particular body? Not yet. But if you're a registered practice that allows you to do a range of services, including audit and other services, within which you can undertake some valuation work too.
Thank you, Ram. Thank you.
So Ram, would you say that the KPMG, PwC, etc. would be having 95% of the market share, or there are small valuers also there, individual valuers who carry out these valuations?
I think we lost him. Sir, you're muted. Can you?
Yeah, now I'm not. I think I just lost connection for a minute for whatever reasons. I think maybe the system is saying it's time up, so maybe.
So Ram, the question is, would KPMG and the Big Four have, say, about 95% of the market for valuations, or is there other the smaller valuers who work in alliances with Indian valuers who do valuations?
While I would not hazard a guess in terms of percentage, it's fair to say we would have a reasonable market share. But sometimes what happens in large M&A cross-border deals, boards also use a lot of investment banks to do valuations, because those are like share swap that happens, or consideration where boards are more comfortable saying Morgan Stanley is doing it, or Bank of America is doing it, or Credit Suisse is doing it, or HSBC is doing it. So we get those as well, right? But you get a range of big fours and below big fours as well who are involved in valuation, sure.
Actually, the insights which you gave us are pretty interesting, and this is something which more than met our expectations, I think, because our intention in holding this was to get the sense of what are the valuation practices in Middle East, and you've given us a phenomenal overview of the market. Most of us really don't think that way, so it's added to our knowledge as to how to look at something from an overall perspective as well. I think that's excellent, actually, the way in which you presented. That's why people were not asking questions, because we were taking in the information first and foremost. Yeah.
No, I wasn't meaning to overdo my role here, but I hope it has been of some value to you guys. Yeah.
Yeah. So when you look at startups, are startup valuations not all that big a market in the Middle East?
Yeah. Okay. Fairly, there is some amount of interest in startups and fintechs, which is coming in now. But those valuations, as I say, is done on what you would call the re-rating of valuations in terms of the stake you get at the entry to saying when does the next pot of equity is raised. So everyone has a structure through which they kind of do it, not on a pure valuation basis, but those kind of small ticket investments are coming in. We don't see some huge big ticket startup deals of what you might call Series B, Series C funding of any significant number.
Mhm. So it's not like an external investor, I mean, a company which is say India-based would want to list on a Middle East market. It's highly unlikely, right?
Not yet, no. But what is happening is, to fair question again, one of the markets in our region, Abu Dhabi markets, is passed a lot of legislation to encourage some activity of this kind and also provide liquidity support for some of this. But at the moment, no, it hasn't kind of gone. If the GCC markets were to consolidate as one stock market, absolutely, it might be an open door to saying a lot more activity is possible.
Mhm. Because in terms of tax advantages, most of our companies tend to go and list in Singapore, let's say, or some other place.
Yeah, that's where
so
more
Abu
technology
Dhabi-
stocks are. Yeah, not yet in this market, not yet.
Okay.
Hello, audible?
Yeah, sure.
If you can just touch a little bit on that terminal rates, how the practices are in the Middle East vis-a-vis India, or at least on the Gulf.
Yeah, I can tell you a little bit that we do. I don't know what happens in India and so on, but India is like, we all use real growth rates as opposed to nominal growth.
I'm based in Dubai, so definitely.
All right,
I'm
okay.
interested.
All right, okay. So you're closer to reality, Ram. All right. So
I have the same name as you.
Sure, sure. Yeah, but we'll never value the same thing, the same number. Don't worry, that's how it is. But coming back to the point of terminal growth rates, we have a huge problem in our markets as well. Sometimes where people think you can just stick a number at the top and the perpetual number throws up a crazy set of numbers at the back end. Now, I'm very generally where if the terminal value contributes more than 50 to 60% of the overall valuation, then I put a cap on it. Because you always do this 5-year tailing off and coming up with some magic. The explicit cash flows are never good enough to saying it contributes less than 40, 50%. So what we do is that we not only look at the terminal growth rates of CAPM, whether you take emerging market growth rates as only 2% as opposed to, putting 2.5, 3 and whatever they say, but history 2% has never been more than that in our markets. But the more important one is we do a back check on the terminal growth rate to say, what does that translate into multiples as well? Because you can't exceed the industry multiples, no matter how you think you are way above anyone else and you have a competitive differentiator, which is perpetual, which is never the case. You can never enjoy those margins, nor can you expect those kind of returns. So we dampen it by some reality checks. But we do get into debates and arguments, but that's the nature of our work, yeah.
Is there a referable list of multiples available, some sort of a glossary or some sort of a knowledge book?
No. This is where gray hair comes into effect, yeah.
Okay, thanks. It was very interesting, quite a lot, quite interesting. Thanks, Sam. Thanks, Ram.
Pleasure. All right, if there are no other questions
from the participants. Yeah, now I would request Mr. Ravindra to formally convey a vote of thanks.
Yeah, thanks, Shilpa. Sir, on behalf of Bangalore Valuer Association and all the participants present here, I wish to propose a vote of thanks for you. I must say the session was very good. You started off in, with creating a context for all of us. And at the end of the session, we realized how important or how relevant it was, this context setting for this program. You started off telling that, this valuation is an art and science. And then you went on to say this, it's more of information in the context and also how fair value is different for different people. And you set up this context by giving a lot of information about this part of the region, that is the MENA region, and where we understood how the energy is playing an important role and how the thinking of those people are playing an important role in the valuation, and how two big countries are, actually the big markets in the GCC region, and how other countries are actually very not so relevant. And also you gave us the complete perspective of the business. You gave a perspective of GDP, the market capitalization, the FDI comparison between India and those countries, and how energy alone is contributing to a big part of that. And this statistical and pictorial analysis you gave was really very beautiful, sir. I must say, it's very eye-catching for us. And also you took us through the dollar returns, interest returns, and index returns, and that analysis was also very good. And how these analysis vis-a-vis COVID was an icing on the cake for us. And how also you took us through the IPOs, how IPOs are active in GCC region vis-a-vis India, and how this unicorns are playing important role in IPOs. I mean, all these things we are going to take back home today. And also how the liquidity is helping in the market activity, and what are the mergers and acquisition, and expectation of the investors, they're more of a dividend than other things, and how they are moving towards the other risk appetites was a good thing. So overall, you took almost 45 minutes in your session to just create the context, and rest was just a smooth sail for us, I must say. And also how the real estate plays an important role, and intrinsic values, and how we have to again relay back on the secondary value. These were all, we are getting into it. And you also took, in case we are not only raising a fair value, we should also go for a sensitivity analysis and importance of alpha buildup. I mean, these things, we really got it very well, sir. Thank you so much for that. And you spent quite a time on this CAPM model also, and the impact of COVID and that CAPM model. And further, you gave us a glimpse at the end of how insolvency is progressing in that part of the region, and how it is different from the advanced or regulated countries. So I want to thank you from bottom of my heart for creating this beautiful impact for us from Bangalore Valuer Association. And on a lighter note, I just wanted to tell you this, in India, we have this, we are all now nationalists, and somewhere I felt that in one of the maps you had taken out the J&K part was sliced. On a lighter note, you could have just...
No, I didn't mean to, because I believe in it. So if it is, I can correct that. There's no intention to sort of,
It was very good session, so thank you so much.
First of all, I thank you, all of you, for having the patience on missing IPL and listening to this. So there must be something in it. So thank you guys, and appreciate the opportunity. Bangalore is one that I will connect to over the next year or two. So hope to reach out and see some of you sometime.
It'd be good to meet with you. And thanks for accepting Narasimhan Ilankovan's invite also. That's a big thing for us.
Thank you. Thank you very much.
Thank you.
Bye. Bye. See you.
Thank you,
guys.
sir. Thank you very much.
Bye.
Thanks, Ram. Bye.
Bye. Bye. See you guys.